Very interesting day in the markets today. VIX up sharply, S&P down sharply. This following some pretty weak trading at the tail end of last week. I've heard people talking about everything from the yen carry trade to the election, you name it. We're going to talk about some of these things, how to handle some of your hedges, and talk about stock recovery plays today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about options, the markets, and take your questions. And if you have some, be sure to leave them in the chat and we'll try to address them. I would imagine that this is a market that has people asking a few more questions than they might normally do. So before I get to that, I don't know whether many of you happen to watch Fast Money. Last Friday, I did that show. If you didn't recognize the background, I was in Sonoma, California, so doing a remote hit from there. Karen Feinerman had asked me a couple of questions while we were on. And actually so did Bono and Eisen, so two of the other panelists on the show had asked questions. One of the questions that was asked, do you sell covered calls and buy put spreads in a situation like this? Those of you who have been following these live streams know that on or about July 1st, I talked about buying SPY 535 puts or SPX 5350 puts, SPX being my usual preferred market proxy, simply because it settles to cash and it's European, just a little bit easier in some ways to think about, for me anyway. But if you did buy those puts at the time, you will remember that I indicated that I didn't think put spreads were such a great idea in that context. Why not? Implied volatility simply wasn't that high. And actually, as I talk about some of these things, I'm going to try to just pull them up on the Bloomberg so we can take a look at how things were. And I'm going to try to actually, let's just make sure we use a chart of suitable length so we can, and by the way, you might have to really take a look at this thing because so that's what we're dealing with. You can see now the VIX truly has spiked, so this is meaningful. We're going to get to that. But asking about put spreads and whether I like put spread collars, I don't generally like put spread collars for market protection in a general sense. There's a positive to it, of course, which is that if you sell an upside call and you sell a downside put to finance a closer to at-the-money put, you will offset most, maybe even all, depending on how you choose your strikes, of the decay that trade has. The downside of that is that when the market washes out, and that's probably a good word for it, or crashes, whatever term you choose to use, the efficacy of that strategy is going to be revealed. And that is that in a crashing market type of a situation, I'm not saying this is a market crash, but it's certainly a meaningful pullback. I think we can all agree on that. You'll find that those things just don't really pay off as effectively. So if you also follow me on Twitter, X, whatever we call it nowadays, you will know that I posted earlier today that I thought it was a good idea to roll the puts, whether it was the SPY 535 puts that you had on or the 5350 SPX, whichever you happen to put on, that it made sense to roll those. I have said many times that I look to about a 60 delta for my time to act. And what I had suggested was rolling down and out to put spreads. CNBC may have published an article I wrote. I actually wrote it yesterday when the futures were down about 100. And I think they just got a little bit swamped over there, so they weren't able to publish it straight away. But I was suggesting there that folks might roll down and out to either a 5,200, 4,500 SPX put spread or the 5,000, 4,500 put spread. Why? Well, the thing is that now that the VIX has gone up considerably, we're living with two new realities that were not true a month ago when I wrote that initial hedging piece. And that is that, of course, first of all, the market's down 8%-ish plus, right? So we're getting very close to correction territory being formally defined as a decline of 10% and a bear market is 20 from the prior highs. So in part, you are contending with a decline where a lot of the damage has already been done. The other is that you are paying up considerably in terms of implied volatility. These are problems, and you want to mitigate that. The other thing is that when implied volatility is very high, the distance between the strikes can be meaningful, and you can still get actually a decent amount of premium for the out-of-the-money put that you're selling. So in this case, the 4,500 if it's the SPX, or the 450s if it is SPY. There's something else that happens when you do this. You're going to be taking in net premium. Those puts that I'd recommended, those were 50 bucks. They went to over 200 at one point today. Actually, let's check this out. Let's see where those things went. I was actually talking about the August 30th month ending. Folks who watch that live stream will know that one of the reasons I had selected those was because I wanted those to capture the DNC. As it happens, the DNC was not the critical catalyst, but I wanted to make sure that they went out at least that far. When I talked about the Russell 2000 Trump trade hedge in the middle of July, I was talking about carrying it out to the end of September, because September typically sees elevated volatility, and we wanted to sort of give some time to see whether the Trump trade was going to catch legs or was going to get punched in the face after the DNC, so we needed more time. That trade also, by the way, could potentially be rolled. So let's just take a quick peek here and see where these SPX 5350s are now. And by the way, I obviously have to recenter this because those are actually in the money at this point. So now we're going to go to the month ending contract. 50, yeah, so I said they went over 200. They actually still are over 200. We'll just call it middle of the road, call it 205. So, you know, up $15,500 per contract, right? And if you were rolling into that other trade that I was talking about, you can take that, a portion of your winnings essentially on the hedge, and deploy some of that to adding to your equity longs. And this is where I'm going to get into what I was talking about Friday and just talk a little bit about the VIX signals, timing, our views on the market, and things like that. So on Friday, Karen had suggested that she was going to do a little bit of bargain hunting, looking for stocks that she could now buy at a discount. And of course, she's a sort of a deep dive fundamental investor. I agree with this philosophy in general. You should know the stocks that you want to buy if you're going to take that kind of an approach ahead of time and know the levels at which you want to buy them. My caution, though, to her was that there's a sense that when the VIX spikes, that presents a buying opportunity. That is true to a degree. And what I did was I said, okay, well, let's just take a look at what happens to the S&P 1 month out, and if it might be a little bit hard to read. So let me see if I can blow this up a little bit. You guys can look at this table. I'll blow this up a little bit. See how. Let's find out how big I can make this thing and see how legible. All right, I'm sort of looking at a return here. Looks like you guys might actually be able to see this. Okay. So what are we looking at here? I'm just going to get rid of these filters for just a moment. So over here in cell F1, this represents the 1 month average return for the S&P as measured by the SPX index since the first trading day of July 1990. What is significant about the first trading day of July 1990? Nothing particularly, except that that is the earliest day for which we have VIX data. So after the VIX index was released, they actually went back and took a look at implied volatility data for the S&P index and essentially retroactively constructed the VIX index going back to that date. The VIX index wasn't actually live at that time, but we have data because we have historical SPX options prices. And so keep an eye on this cell. Let me highlight that cell, actually. I'll just highlight it in yellow. All right, so this is the important number that we're going to try to focus on at the moment. So 85 basis points. What is in cell F1, regardless of whatever I do anywhere else, what you're looking at is the forward-looking returns for the S&P 500, 1 month forward. And now we can start to filter on things and say, okay, well, what happens if the VIX was above 20 as it was on Friday? And this is where people get caught out, because they will say, oh, okay, well, so we'll just go greater, and we'll say it's greater, the VIX is greater than 20. Watch what happens to this number. Bingo, it goes up. Now we've got 114 basis points. And they'll say, brilliant, okay, well, the VIX is now higher, buying opportunity. Not so fast. Why not? Well, the thing is that the VIX has to go through 20 on its way to even higher levels. So we care a lot about, because the VIX between 20 and 30 is not a normal circumstance, all right? That is a period of elevated volatility. We know that volatility is mean reverting. We know that it tends not to stay in some sort of range like that for lengthy periods of time. So we care a lot about whether, when the VIX is at these levels, it was on its way up or on its way down. So how do we take a look at that? Well, we can take a look at that by saying, all right, well, what was the 30-day moving average for the VIX? And I'm picking it's a calendar thing. I'm looking 1 month out for the S&P, so I'll look 1 month back for the VIX, whatever. Pick whatever you want. What I'm really looking for is, are we breaking well away from the 30-day moving average, or are we falling back through it? So when we start looking at that, what we saw was that what happened was we were on the way up, and significantly, right? And when you start taking, oops, I must have put this into the wrong thing. So let me see what we did here. I just filtered something. What did I just filter? I did something that I did not mean to do. Sorry about that. Oh, I think I put it into this column. Let me just, clear that. Yeah. All right, so this is the one I think I was going for. All right, so here we go. Now, what I've done is I've said, I figured out that last Friday, the VIX was about 50% above its 30-day moving average, which turns out, coincidentally, to be about 1% of the time, which seems, we're dealing with an unusual stressed situation, so why not take a look? And what we find is that if you are looking at situations where the VIX had done that, you get returns that are actually not well above average. Keep an eye on that yellow cell. You get returns that are significantly below average. And that is because you are deciding to catch that falling knife. The VIX was low, it tracks higher, now it's above 20, it's had a 50% increase. You are picking up a lot of the days where you get big washouts thereafter. Okay, now though, that big washout, which is exactly what I was saying to watch out for on Friday, we got this big washout over the weekend. And I'm not saying that we don't get into a formal correction. I actually think we could. I think that's a very reasonable expectation. We haven't had one for a while. I'd say we are overdue. We've got plenty of economic concerns. We've got plenty of other types of uncertainty. Everybody's yammering about the big unwind of the yen carry trade. But I think that if you had these hedges on, you have to bear in mind that once you start getting to VIX north of 30 now, take a look at this. Now we're starting to get to a much more interesting point. Now, I want to tell you something else. If you take a look over here, I'm just going to highlight this other cell over to the right. So I'm going to just unhighlight this one. 64%. What is that? 64% of the time, the S&P is higher over any 1 month period. The market generally trends higher. It is higher more often than it is lower. That's the reality going back to January of 1990. So we're looking right now at a nearly 35-year history as we look at that. Now that doesn't update automatically, but this number over here, which I'm going to highlight as well, put that in the center, that is the percentage of the time that the S&P is higher when you're starting with the VIX in the 30s, okay? So this long-winded introduction that I provided today, what am I talking about? When the VIX spikes, it does present an opportunity to monetize your hedges and to deploy more capital to the S&P. If you're a long-term investor, it's a better day to invest today than it was on Friday. That should be obvious, but it may not have seemed obvious when the market was rolling over. So what I'm saying is you can look at other types of data like this and say, okay, well, maybe this is something we can do. That does not mean don't be hedged. I still think you need to be hedged because, like I said, I still think that we could very easily enter a correction. I think we're overdue. Many times you get these kinds of declines. That's where you end up. But you also should not simply be rolling those 5350 puts, which we put on when the S&P was about 5,500. You shouldn't necessarily roll those now. The S&P is, let's see where we ended up closing today. Let's just double check. Should probably know that right off the top of my head, but I was actually dialing into this. 5185, so the 5,000s. Do you just roll out to a 30 to 45 day 5,000 put? No, because the implied volatility is much, much higher, and that higher implied volatility means that you can actually sell a much further out of the money put to get some protection. Sell the 4,500s and you're probably going to, offset a decent amount of premium. You get pretty close to at the money protection. I was actually looking at the 5,000s. I think the market had recovered back to about down 130 handles. That's some kind of recovery, right? Recovers to down only 130 handles in the S&P. Anyway, so that is my thinking here. And chances are you're going to probably have time to do some of this tomorrow if you have not already. Okay, so Tony Zhang of OptionPlay, I wasn't on the call, but he mentioned to somebody else that it would probably be advisable to talk a little bit about stock recovery strategies. What is a stock recovery strategy? For those that don't know, a stock recovery strategy is something that you do if you own a stock and it has fallen considerably and you are looking for a way to boost the near upside returns in case the stock recovers somewhat so that you can claw back more than the losses that you incurred from its recent decline, or maybe most of the losses that you incurred on a recent decline, even if the stock does not get back to its prior highs. Let's pick a stock to choose. We'll pick a stock that I generally kind of like. So we can take a look at Amazon. Amazon was, let's see where we were. Why is that not refreshing? So Amazon was at its highs $200. And we are now about 160, so down $40, 20%. Round numbers, right? Let's not, now's not the time to get too particular and deal in cents. What are the chances that Amazon gets back to 200 in the very near term? Well, it's going to be pretty tough because we don't have any obvious catalysts that are going to do that. The market is clearly very heavy. I think the multiple people are going to assign is going to be a lower one no matter what happens, but you're just not going to get new information that is likely to take it back to that level. And even if it did get back to that level, so if you happen to buy it there, if you're even thinking about a stock recovery strategy, part of the reason you're doing that is because you're just hoping to get your money back. Anybody who's just hoping to get their money back, some will be inclined to sell there, as Carter Worth often says. Creates overhead supply. Overhead supply creates what? Creates resistance. So that is part of the problem. The other part of the problem is that we have this gap right here. So if we can, let me blow this up. And I didn't do that very well. Where am I? Maybe somebody on the production side can tell me why it is that I'm sure it's a setting. I've done something to my OptionPlay somewhere, but it's defaulting to some point in the past whenever I pull up a new symbol. Okay. Anyway, up top left over here. Show heads-up display. What did I do? Okay, well, I'm not going to, okay, well, we're going to get back to that because I want to make sure I stay on the conversation. But anyway, so we have this gap here. And that also, one might assume that if we can fill that gap, and gaps go filled, but that's, the other thing we're going to take a look at. We have some other potential areas of resistance even before we get back to 200. Okay, so what do you do? Well, one of the things you can do is you can look to put on an options trade that gives you some upside against your long stock position without laying out additional premium and without potentially being forced to commit more capital to the stock. So what does this tell us? For one thing, this means that you cannot use a short put in any way, because a short put does what? It obligates the seller of the put to purchase the underlying stock at the strike price if they are assigned. So that would be a way that you would be committed to contributing more capital. So what you can do is you can look for a call spread that you can put on at zero cost, covered by the stock, like a 1/2 call spread. So if we take a look out at October, and we take a look at, say, something like the 170, 190, that's not going to quite do it. 179, 185, maybe here we go. So 175, 185, that thing is going to be on at a credit against the long stock. You're going to get a structure that looks a little bit like this. So you'll notice you get a little bit of a boost in here. So between 175 and 185, you will actually double your rate of return relative to the stock. So the stock, the equity line, we often call this the equity line. That's the 45-degree angle. It represents stock goes up $1, you make $1, and so on. That between 175 and 185, as of expiration, you would actually, between 175 and 185, be making $2 for every dollar that it increases, right? So that what that means is that between 161 and 185, for $10 of that range, you'd actually be making not $1 for every buck it went up, but $2. The downside, of course, is that the upside will be capped at that level. And you'll only be worse off for having done this if the stock goes above 195. Why? Because you'll have made $2 for every dollar that it went up between 175 and 185. You're making nothing for every dollar it goes above 185. So you're not getting the dollar you would have gotten. But because you made $2 all the way up, you're still better off all the way to 195. 195 is kind of interesting. Why? Because it's just below what we know is going to be resistance, which is the prior high of 200. Right? So that is an example of a stock recovery strategy, that kind of a thing. Other things that people could sometimes do is you can, and you will probably more likely see this kind of thing, in and around situations where you have tax considerations, maybe some tax loss selling. We're clearly not there. I mean, we're in early August right now, but it's unlikely anyone's going to be doing something like that. But the other thing is stock substitution or replacement strategies, where you can sell your stock because you don't want to take too much additional risk, but buy calls or buy call spreads to take a long position there. Okay, so I just wanted to make sure that we got that out of the way and take some other questions. When is it safe to go full port on svix commons? Yeah, so for those who are not familiar, and let's take a longer term look at this because I think it's going to be kind of interesting. So and we need to look at this over a longer period of time. So you like to short volatility, then this is the kind of thing that's interesting to you. So what this is a short VIX strategy. VIX is the ETNs or ETPs, exchange traded products that track the VIX. And actually this includes all volatility related products, ETPs. I don't really care whether you're talking about VIX futures, you're talking about options on VIX futures, the VXX, SVIX, you have these levered products. Most of these products that are long VIX, just as a part of their process, have decay. They have significant decay. There's many reasons for this. One, implied volatility is usually, for these products higher than realized. So you're going to have that issue. They have to roll. Oftentimes they're trading VIX futures underlying, and that term structure is generally upward sloping. And so all of these things create decay. And so the truth is that these are not investment products. A better investment product is actually to be short volatility, which is what SVIX is. And I think the question here is, if it was a good idea to short volatility in general, isn't it a much better idea then to short it when you've seen a big spike like this? And I think the short version of that is yes. So one of the things that will happen is that even if you get sort of a market crash and volatility spikes up, oftentimes over time it will begin to come in even if the market trends lower. So, and let's take really extreme examples. Let's go back to the GFC, Great Financial Crisis in 2008. Market crashes in October of 2008. VIX spikes, I think it gets to 80-ish, thereabouts. The absolute market low for the S&P in the GFC actually didn't take place in 2008, although that's when the market crash really did. The dead lows for the S&P didn't take place until March of 2009. But if you take a look at the VIX, why am I telling you rather than showing you? My bad habit, somebody remind me please. The VIX never got back to those prior highs. So let me do this. We're going to look at this from 2008, mid-2008, and we will go to mid-2009. So we're going to look at VIX. I'll highlight this so that it gets a little bit of... Okay, so what happened? March over here, this represented the lows for the S&P. But it did not represent the highs for the VIX. That took place in 2008. And now I'll just throw the SPX data in here so we can get a look at that as well. Map them over one another. And I don't want to normalize that. That doesn't help. Okay, so hard to see because of the color it chose. Here's blue. Absolute low for the S&P right here in March. Yes, VIX was elevated. Yes, by the way, great time to buy the S&P, but well below its all-time highs. Now, I don't know whether we're going to get some kind of a washout like this. Not really expecting it. I don't think the same dynamics are at play. We have a lot of things that are worrisome, but it's not worrisome in the same kind of way. What was going on then? We had a lot of really bad credit. There was just a lot of mortgage bonds and associated products that were complete crap. And as people began to realize that, that's what really caused this problem. We aren't quite in that situation. I think, bank balance sheets are still a little bit impaired because you've got these huge unrealized losses in the HTM books, even Bank of America and so on. But in general, we're not really in the same situation. I think we're playing off of global political fears are certainly one issue. It just doesn't seem like things can calm down in the Middle East. That's a problem. Taiwan is always a problem, what China might do. We still have the war in Ukraine. We have what looks like a very messy and unpleasant election cycle for the US presidential race, with two candidates that, well, Let's put it politely, I guess, as politely as we can. Both candidates are somewhat controversial. I think the Democrats right now are doing their utmost to try to make sure that Kamala is less controversial, but let's be honest. She was not tremendously popular, even within her own party, not that long ago. These are problems. So I think we're in for a choppy one. And let's take a look here. Next question. Thoughts on Micron Tech, October 18th, in the money 80s, at the money 90s, and out of the money 100 long calls. Its all-time high is 157. Post part of their quarterly earnings report, nothing changed since then. Next report is on September 25th. So I'm assuming that's, well, I'm sure they haven't declared that, but I can see that that would be a reasonable time. Let's just take a quick peek if that's also... This is not the Bible, by the way, just because Bloomberg has an estimated earnings. What do they have? They have the 27th, for what it's worth. So Bloomberg thinks the 27th is when they're going to be reporting. Like I said, company's going to announce formally when they're going to be reporting, but it's going to be in and around that time. What are we looking at here? Short sale restricted. Are we getting back to a long-term trend here? What do we have here? It does look like it actually came back to, if we drew some lines in here, going back to late 2022, let's just take a quick peek at some other technical studies. So we'll let the machines draw the lines. I'm using a trackpad right now, so I wouldn't be able to draw them very effectively anyway, and it's probably not why you're going to tune in to see me. I don't blame you. Let's just take a peek here. So most of the technical indicators are still leaning bearish for Micron here. Remember, buy and hold. So that always shows up on this default table that I show. If you can see my cursor, which I hope you can, that's not a technical study. So we dismiss that one. There's 22 in here. We can see this one here, trading envelopes, is the last one that is bullish. All of these are bearish. All of these little down arrows, which are probably hard to make out, but I'm just sorting. So these are all the strategies that would be long. These are all the strategies that would be short. RSI has no position based on the settings that I have in here by default. Not for nothing. Use this however you will. But I think that if we take a look at the history over the last year of the trading profitability of these technical indicators, that we can safely say that all these that are bearish, these all have a profitable trading history. This one not, but by and large, it looks like the better performing technical indicators for Micron over the course of the last 52 weeks are not getting long here. Okay, so I realize that doesn't sound overwhelmingly positive, but let's just take a look at a couple other things while we're at it. How does this thing stack up relative to its own historical multiple? Well, on this metric, and we could probably expect this to be true because Micron's been trading very, very cheap. Micron's not like going to be the NVIDIA type of a story, not idiosyncratic. It's based a lot more on pricing. And so we have some pricing weakness, and that plays into this. But it is certainly trading at a material discount to its own historical average. Right here, we're looking at a 2-year historical average. So this is the range. So if you were saying forward, this is, basically, whenever you see BF, this is the forward estimate numbers. But on a forward PE basis, it is way below its average level. So the average is this orange diamond right here, 39% higher. This is where we are right now. So basically on every single metric except for price to book, it is much cheaper than its own historical average. It is also, it should be said, trading at a meaningful discount to the group. So in white here, this is the mean for the group. You can see what names are included in that group down here. 24 times forward earnings estimates are the average. It is trading 10. So cheap. Like I said, it kind of looked to me like it was coming down to that long-term trend line. Has a decent amount of cash. If they live up to their cash flow projections for the full year ending at the end of this month, they'll have generated about $1 billion in free cash flow for the year, and they're forecast to do about $4.4 billion for the next year. So no real visible problems there. In terms of how the street feels about it, might as well take a look at that as well. Overwhelmingly bullish, so we can look at that however we want, but it isn't as if you're going to have a lot of people saying, okay, well, we're just going to try to blow this thing out because we don't like it anyway. That doesn't seem to be the attitude. So it's cheap. I see a trend. The technical strength is the one thing that worries me a little bit. But I agree with you that the earnings catalyst could be, the thing that sort of snaps it back. And bear in mind, I mean, it's in a day like today when everybody's going to say, sell it all. CNBC asked me to come on in a little bit. And I will be probably around 7:30. And you know it's going to have some blood on the streets, turmoil in the markets kind of a headline. That's just the way it goes. And I don't think you want to hit bids when you start seeing, when everybody's panicking. I actually tweeted out earlier today, tweet, post, whatever, the quote from Warren Buffett, where I'm going to paraphrase now, but it was in his 1986 chairman's letter to the shareholders. Be fearful when others are greedy, but greedy when others are fearful. Right now, others are being fearful. Okay, so Micron Technologies, yeah, I'm okay with that. Just don't expect necessarily that you're not going to have a little bit more weakness. But remember, I'm still saying that I think we could easily go into correction territory, which is down 10. But you're buying the thing at 10 times earnings. There is growth. There is positive free cash flow, and you're getting it at a much better price than you would have been. So okay. Okay. Hey, Mike. What is your advice for trading futures in this environment? Stop losses, or not at all because it's too dangerous. Well, first of all, I don't really think of futures as being dangerous. Futures are not dangerous any more than stocks are. Options are not dangerous in my view any more than stocks are. What makes things dangerous isn't the instrument, it's leverage. Well, actually, there's a couple things. Leverage is one. And in the case of options, timing and decay on the long side. So more often than not, when people start trading options, the very first thing they do is they don't go far enough out in time. They go too far out in terms of moneyness. And they don't, it's not an issue of leverage the way they're probably thinking about it. I'll give you an example. I have $100,000 in my account and I commit, let's say, no more than 2.5% of my 100,000 to any single name that I'm putting in it. So what does that tell me? That I can put $2,500 in 1 month out of the money call options on stock ABC? Well, no, because it's true you're deploying only 1/40th of your capital to that $2,500 in premium, but the probability of profit on that is very, very low, right? So the leverage the way people ought to be thinking about this is that that $2,500 in premium, thinking about how much underlying stock you're actually taking on when you do that. And I think if you think about it that way and say, okay, well, I would have taken a 2.5% position out of the 100 in this stock. Let's say it's a $25 stock, so that's 100 shares of stock. Maybe you can deploy a little bit more to call options than you would have in terms of shares. So, that would be one call contract, but the amount of premium you're going to spend is going to be much less. And then you spread that out over a 12-month period, and you're going to find that actually the risk comes down. So the biggest problem that happens when people start trading futures is they take a look at the margin requirement as if that's the capital deployed. So, if the margin requirement, I wanted to come up with an example. Let's just take crude. So let's say that the margin requirement for one single West Texas Intermediate crude contract, that's a NYMEX contract, is, so speculator, the initial margin is $7,300, right? Again, round numbers, that's the only thing that really matters. Well, that's $7,300 on a $73.81 contract with a $1,000 multiplier. So you're taking exposure to $73,820 worth of crude for $7,260 in margin plus commissions. Well, that's a decent amount of leverage. So it's 10-to-1 leverage. So that's actually where I think people get, I don't have a problem with trading futures or with trading crude. Crude's probably been a heck of a lot less volatile than equities have lately. I mean, we'll just take a peek at what's the range been. So we're down at 73.80. Of course, like all risk assets, anything it's down. It's been trading in this range. It's between 72 and $84 for the last year. So, if you think about the notional exposure that you're taking rather than the margin exposure, then it's totally fine. So that's the first part. It's not that I think it's too dangerous. So I just want to make that clear. I do think, though, that people should be prepared to, prevent some additional losses. Do I like stops on the future side? Well, I'm not crazy about them on the commodity side. And this is not a conspiracy theory kind of a thing, but back in the day when I was on the New York Mercantile Exchange and everything traded in the big pit, open outcry, one of the things that one would be concerned about was the possibility of somebody running the stops, right? So what does that mean? The broker pads, people had all of the buy orders, all the pit traders had all the buy orders on one side, all the sell orders on the other. And you basically stack them in terms of their prices, their limits, and their stops. And a lot of people used stop orders. And if you were going to sort of trade with that knowledge, what you hoped would be that people would set stop orders in and around common levels. And then you'd kind of hope that you would trigger those stops. And not me. I was not. Don't blame me. I was trading on the options pit, but I'm just telling you how it was. The hope would be that they'd run the stops that would trigger a wave of sell orders, and chances are the last thing you wanted to be doing was being a seller into that environment. You actually want to be a buyer. They could run the stops. The guys that were buying were the guys that ran them. So look, this is more of kind of an inside baseball commodity type of thing. But I've just never loved stop orders. I never loved stop orders in, for example, we also had the flash crash. Now, a lot of those got busted, rightfully so. But if you're going to put just blanket stop orders in there, there's a lot of risk to that. You could find yourself selling at really crappy prices. So instead, if you're going to think about things in terms of stops, do it manually. That is, just don't leave the orders just sitting out there. I just don't like that. It's just, I've seen things go wrong on that too many times. And then size your trades notionally so that you can accommodate that reality, because a lot of the reasons that people use stops is because they think, well, if I'm not in front of my screens and I want to blow my position out, how do I do that? Well, stop orders, maybe use a stop limit, I guess, and it would have to be a marketable stop limit. I'm in XYZ, I want to stop it's at 100, I want to stop myself out down 10% at 90. I don't want to have a market order because God knows what bid I'm going to hit. Well, you can't have a 90 stop with a 90 limit, because the chances that you're going to catch that 90 fill if the thing's actually falling out of bed is pretty slim. So, 90 stop, 88 limit, that kind of thing. Just saying. I apologize if that's not super helpful, but my 2 cents on that. By the way, all of us have these little biases and prejudices about trading just because of things we've seen, and I'm sure there's somebody else who has a different experience. Okay, let's find another one. CrowdStrike. Yeah, I don't think that's a question. Oh, in reference to us. Yeah, so somebody was just telling me that that was in reference to the stock recovery strategy. Oh, you know what? This is a good point. Actually, it is a joke, but then it's not, right? So what do I mean by that? So there's only so much we can do. The higher the implied volatility becomes, the more room we're probably going to have for a recovery strategy that involves ratio overrides. For example, as CrowdStrike. Would you do the same? Oh, here we are, yeah. So would you do the same 1x2 on Crowd? So let's take a look at what the issue on something like this is. And again, I know that I've obviously done something to my, I've done something to this. It's not advancing the clock, so I don't know what I did. I don't know what I did here. That's rather annoying. So anybody who has done the same thing that I did and figured out what they did so that it's by default. I don't know if you saw what I was doing, but here, I'm going to close this for a second. And I know it's something, it's absolutely 100% my fault. I did something setting-wise in here, but basically I'm just going to show you. I'm putting this in, and it's going to, by default, some time setting that I must have selected. So this is June of 2023. Why is it doing that? Not sure. Until I figure that out, we'll use this machine. That's why I spend so much money for the Bloomberg, so that when I forget how to use my other applications, I can go back to this. All right, so here we are. 400 down to 200, round numbers, 220. You are not going to find a recovery strategy for these types of declines, even though, because if you owned it at 400, and so now you're down 180 bucks. Again, I realize it's not that much. Nobody actually paid 400. I don't think it actually got that high. It was like 390 something. But it just keeps the math easier to talk about it this way. So you're down $180 on a $400 stock. Now vol is of course much higher. Vol is much higher because CrowdStrike's got problems. Vol is much higher because the market's got problems. So in theory, this does set up well for a stock recovery strategy because there's a good chance you can get a pretty wide spread off for no premium outlay. For example, the October 250, 280. The 250, 280 1x2 call spread actually is a credit, right? So that's a $30 1x2 call spread that you could slap on to your CrowdStrike position. Now, if you happen to have bought it at 280 and then watched it come all the way into 220, this could be a very good strategy for you. Heck, if you bought it at 310, this could be a pretty good strategy for you because you're not going to be any worse off for having put this on unless the stock goes above 310 by October expiration. Anybody want to hold their hand up and saying that they think that it's going to be above 310 by October expiration? I don't think so. Pretty low probability that that's going to be the case. This thing was trading at a huge multiple even before all of this bad news came out. And it's not like a lot of good news is going to come out between now and then. So if you owned it, at 300, 310, something in there, even at 320 and you're trying to get some of your money back, this is a strategy that's going to work. But if you owned it at 400, I'm sorry, I can't help you. You play with fireworks, when that M80 goes off in your hand, the doctor can do some things, but it might not be the same as it was before that. Right? Okay. Alrighty then. Let's see what else we have here. Just started to read your book. The options edge, very good. TSN pick from Mark is working out great. Okay. Yeah, the options edge. So we've only done one edition of this. For those that don't know, we published a book called The Options Edge. I think it was published by Wiley in 2016. Some of you really astute readers are unbelievable. Go through and you actually code every formula. So I believe in the early pages, one of the put formulas, and now most of you are not going to do this. It's a book about theory, it's a book about trading, it's a book about constructing strategy. But if you're actually programming the formulas in, I think it's the put formula that the somewhere in one of the exponents we have a sign reversed. And some really astute reader who sat there reading every single page, coding every formula, building spreadsheets and models off of it, caught that error, and we haven't done a second edition. So if you are going through this exercise, I had this problem myself. I was a little bit of a calculator geek. We used HP 12Cs before we had handheld computers on the trading floors, and somebody came up with an app for an iPhone for the HP 12C, and I was really, looked just like it, and I thought, oh, this is great. Now I have an HP 12C that I can carry around by just pulling up the app. And I sat there and I coded one of Peter Carr's options models into it. He had come up with an options model that you could code that incorporated dividends, because the original HP 12C did not have enough lines of code, so you had to use a simplistic Black-Scholes model. The HP 12C Platinum, I think it was, had more lines, and then of course if it's on an iPhone, which is a much more powerful device, you could do whatever you wanted. So I put it in, and I kept doing, and I drove my wife crazy because I was sitting there click, 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 trying to code the stupid thing in. And it turned out there was a flaw in the application. So if you're going through the book and you struggle, page 27, page 37, it's years since I remembered exactly where it was, but it's in the early pages, so that's just one thing. As far as I know, it's the only error, though. Thank you for reading it. Okay, Bank of America, 8th highest credit default swaps. Yeah, I don't... Actually, Easy Mike, so I just put this up. Are you talking about Bank of America? Because I see your caps there. Or are you actually talking about the credit grade? You might be talking about the credit grade. Yes, I think you are. Sorry, I actually thought that was originally about Bank of America, but I don't think that's what you're talking about now. No, you're actually talking about... so MBS, Buffett dumped for some reason. I don't know. I'm not 100% sure what you're referring to. I'm going to try to look into that and see what it is you're talking about. I will say this. This is just sort of a general question on, I'm thinking now about CMBS rather than just mortgage-backed securities, but we have seen some unbelievable transactions take place in the commercial real estate space recently. So there was a property that auctioned last week. I believe it was maybe West 51st Street, something like that, like 151 West. It was, that area of Midtown Manhattan. Half-block building, mid-rise. Peak valuation 8-9 years ago, $335 million or something like that it went for, and it auctioned for single digit, $8 million last week. Which is just a mind-blowing number. 8 million is obviously a teardown number. I think they were doing some estimates and they figured it was going to be $200 to $300 a square foot to get this thing sort of back to where it needs to be. But there's some people saying, look, I mean, the building may need to come down and they need to put something else in its place. Those kinds of numbers, to me, as unbelievable as it may sound, I mean, it's hard to figure out, okay, so where's all the capital supposed to come from? And the interest rates are significantly higher, and there's still a lot of damage. There's still a lot of non-performing stuff on the commercial side. But I got to tell you, I mean, when you start seeing things trade at those kinds of numbers, 1/40th of what that building traded for, Midtown Manhattan, 1/40th of the price it traded for 8 years ago. I got to tell you, it feels much closer to a bottom than a top. At least in some places, for whatever it's worth. Okay. I better check the timing here. Okay, because it's actually 10 past 5, and I'm going to need to confirm that because CNBC wants me on the air, and I may run over to the studio for that. Okay. Well, I mean, there's some other good stuff here. Look, I mean, it's a tough day to sort of listen to me just rant. Oh, InvestWise, Tesla. So many of you will probably know that, you know, I don't value Tesla like I do other auto companies. I don't even think of it completely like an auto company. I'm a big fan of their products. Big fan of Elon Musk. I don't think it deserves the same multiple as some of these other businesses. That said, a pretty tough environment here. Oh, okay. Oh, this is on recovery trade timing things. Yeah. So, you know, to me, I think it's, recovery trade timing. So this brings up a really interesting point. So let's say you are looking at a situation like this. Has this thing completely bottomed out? I don't know, but I will say this. This is the kind of situation where if you are still kind of thinking that you like it, I would much rather a stock recovery play in here than committing more capital to the stock. Because like I said, I don't think that the damage is completely done. And here's an important point about that. The damage, you know, if we get into formal correction territory or worse, never rooting for that, by the way. In the long run, nobody makes money in bear markets. That's just something, I mean, maybe Jim Chanos, a handful of other people, but I just don't think there's much of a living just being a perma-bear. I've never really believed in that. But committing more capital to a name like Tesla here, I think is risky. So I actually kind of like the 1x2 there, if you happen to own the stock, because I just don't think we're going to get a bounce back to prior highs. And, you know, he doesn't seem to have, at this point, a very favorable, you know, as I would also think of, and this is more of a personal, and you know, a personal versus partisan type of a thing going on. Elon's relationship with the Democrats, I think, right now is pretty strained. And it seems like his relationship with Donald Trump, for whatever it's worth, I don't know that it's worth that much, but it seems like it's certainly a little bit better. What I'm saying is that, I mean, as Kamala does better, I don't necessarily feel like that's better for Elon or his companies. For more on that, you might actually want to listen to the conversation that he had with I think it was Jordan Peterson conversation. He's done interviews with a couple people, Lex Friedman, Jordan Peterson. But at the tail end of that conversation, he discusses how the feds were going after SpaceX for their hiring practices for asylum seekers. Now, for those who don't know, companies that have technology that could be deemed to be dangerous if it fell into the wrong hands, like rocket technology, would fall into this category. We have pretty strict restrictions about who those companies employ. This makes good sense. The country does not want to employ our enemies and put them into positions where they could learn critical things about very sensitive technologies. That's just foolhardy. So we would never do that. And in fact, there are regulations that prevent it. Okay, so we understand where that comes from. And companies that would be affected would include companies like Boeing and Raytheon and Lockheed and, of course, SpaceX, because SpaceX makes rockets. This is, they have technology that could be dangerous if it fell into the wrong hands. And the government went after SpaceX for not hiring asylum seekers. Now, that's interesting because an asylum seeker, by definition, is someone who's seeking asylum but hasn't been granted it. and therefore they are not a citizen, and they haven't been granted asylum, one can imagine that there would be, in that mix, potentially employees of SpaceX that wouldn't pass that first sniff test. So it's hard in situations like this where, was that politically motivated? I don't know. Elon wasn't willing to commit to that either. But it feels like it's potentially politically motivated, and it certainly doesn't feel reasonable. And we don't like to see companies we invest in facing unusual and unreasonable pressure from government. That's just not helpful. So, I think that's an issue. I think it could affect the demand side a little bit. I think the neighborhood where we live in, Tesla's became, I think, the #1 selling new car around here. We're on our second, but I think that he could face a little bit more pressure. I think his companies could face a little bit more pressure, and I think the markets could face a little bit more pressure. So 1x2s probably make a lot of sense there. So I would love to carry this conversation on a lot longer, and I would if I could. But unfortunately, because I'm being called on by CNBC, and I'm going to probably head over to the studio shortly to share some of my thoughts with those guys, I'm going to have to cut this one short, having squandered yet another one of your hours, for those of you who stuck around for that. As always, I really appreciate it. Really appreciate your comments and questions. You're clearly a very thoughtful bunch, and enjoy the interaction. Like, subscribe, tell your friends, and leave us suggestions, and we'll try to incorporate them in the next one. Thanks for watching.